Today, we're exploring an asset class that's been gaining major traction recently, private credit. If you've been wondering what it is and why so many high-income investors are talking about it, you're in the right place.
That's right. As banks continue tightening their lending standards, a huge gap is formed in the lending market, and private lenders are stepping in to fill it. This has opened up new opportunities for investors to earn strong yields by becoming the lender instead of the borrower.
So what exactly is private credit? At its core, it means lending money directly to a business, project, or individual without going through a traditional bank. These are non-bank loans, and they're typically arranged through private funds or individual deal structures. There's a wide variety of deals that fall under the private credit umbrella. Think short-term real estate bridge loans, corporate debt, mezzanine loans, and asset-backed lending.
These loans are often collateralized, meaning there's an asset behind the loan, whether it's real estate, equipment, or even inventory.
In exchange for taking on that credit risk, investors typically earn higher yields than they would from more traditional fixed income investments like treasuries or corporate bonds. We're talking returns in the range of 8 to 12%, sometimes more, depending on the risk profile of the deal.
One of the key features that makes private credit so attractive to investors is the potential for steady, predictable cash flow. Many of these loans pay monthly or quarterly interest payments, so you're not just watching a number on a screen, you're actually receiving regular income.
Let's take a moment to talk about the capital stack, because understanding where your investment sits in the capital structure is critical to understanding the risk and return potential of private credit. The capital stack is a hierarchy of who gets paid first in the event something goes wrong, like a bankruptcy or default.
At the top of the capital stack is senior debt, then mezzanine debt, followed by preferred equity, and finally common equity at the bottom.
Most private credit investments fall into the senior debt or mezzanine debt categories. Senior debt is the most secure. It gets paid first and is usually backed by collateral. Mezzanine debt is a bit riskier, often unsecured or junior to senior loans, but it offers higher returns as a result.
Here's an example. Imagine a real estate development deal. The bank provides a senior loan at 60% of the value, and private investors step in with a mezzanine loan for another 20%. If something goes wrong and the project is sold at a loss, the senior lender gets paid first, and the mezzanine lender only gets paid if there's money left over.
That's why risk management and underwriting are so important in private credit. Good lenders perform deep due diligence analyzing cash flow, collateral, borrower history, and more before issuing a loan.
Now let's walk through how private credit scores using our FastFire Investability Score. Starting with return potential, we give it a B. Private credit offers solid, above-average returns without requiring the kind of speculation you see in venture capital or crypto. Think of it as aiming for a strong, consistent double, not a home run.
Next is risk profile, also a B. Yes, you're taking on credit risk, but in many cases, there's collateral involved. Experienced lenders use strict underwriting to reduce the chances of default and loss. Last is accessibility. This is where things get more challenging. We give it a C. Many private credit deals are restricted to accredited investors and require high minimum investments, often $250,000 or more. But that's where FastFire Capital comes in. We've used our network to gain access to an institutional private credit fund with $1 million minimum investment, and we structured a feeder fund so our investors can get in for as little as $75,000.
That's a huge deal because it opens up a previously gated asset class to more investors without compromising quality or performance.
And remember, our mission is to help you grow and protect your wealth by making these kinds of investments more accessible.
So let's recap. We give private credit a return potential of a B, risk profile a B, and accessibility a C.
If you want to see how private credit stacks up against other asset classes, download our Guide to Alternative Investments at fastfirecapital.com/guide. And don't forget to like and subscribe, as we will continue to break down various other alternative investment classes the ultra wealthy use to grow and protect their wealth. See you next time.